So I described before, gave you a definition of what I mean by state and local taxes here. So these are taxes that were paid during the year for income taxes paid to the state, property taxes paid to the state. Now, we have a lot of states that don't have income taxes. There is the option, instead of taking a deduction for income taxes, state income taxes, that you can take a deduction for sales taxes that were paid instead of income taxes that were paid. There is actually, now that's kind of you can try and keep track of all of the sales tax you paid during the year. That would be a bit of a nightmare. There's also a formula that can be used. There's a table that the IRS uses. It's based on what your income is and where you live as well. So they just pop out a number, and that's for those individuals who live in states where there is no income tax, because they've still paid taxes, right? So they do get that opportunity. You can, and anybody can use that if their sales taxes, if the sales tax calculation is higher than the income tax calculation. In Iowa, usually you're not going to find that. Iowa's a pretty mid-range state as far as income tax rates, so you're usually not going to find that. The next section that we talk about here are state and local taxes. So, personal property taxes. Now, personal property taxes are different than real estate taxes. Personal property taxes, we call it car registration in this state. That is a personal property tax. So that's what they're talking about there. There are certain states that, and jurisdictions as well, that tax all kinds of personal property. There's a distinction between real estate and personal property. You'll see that distinction even more clearly when we get to chapter 7 and talk about different types of assets. But so personal property taxes, think vehicle registration fees, okay? Real estate property taxes, think property taxes that you pay on your personal residence, or could include other property that you own as well. Other state and local taxes, so these are income taxes or any other types of taxes that, they say other here, so that kind of includes the sales tax. But remember, you get a choice between income taxes and sales taxes, and then foreign taxes as well, which I had mentioned earlier. For most people, that foreign tax credit is going to be more valuable than taking foreign taxes here, but there are certain situations where it could be advantageous to take a deduction instead of use the credit. So the thing about taxes that is hard to remember is, so if you think about, this is a Schedule A for 2022. You're filling this out in 2023, right? 2022 has ended. So these are taxes that were paid in 2022. So whatever the tax year is on that form, that's when the taxes were paid. So if it turns out that you do your taxes and in 2023, April 2023, you owe additional income taxes to the state of Iowa, and these are taxes paid, not refunds received. You owe additional taxes. That additional payment is not a deduction on the 2022 return, because that payment didn't take place in 2022. So you really have to think, when did the payment take place? It has to take place in the same year of that form that we're using. And it always says on the form, what year it is. So for 2022, if you owed money on your state income tax form for the previous year, or for a year before that, because you paid it in 2022, that's when it's deductible. It can be kind of confusing to try and keep that stuff straight, because we're talking about multiple years here, because there's overlap. It can be sometimes be kind of a nightmare. Another nuance here is for, especially in the state of Iowa, personal property or real estate taxes. So if you've ever owned a home, I don't know, has anybody ever owned a home? in here?
Not yet.
No? Okay, well, you will someday, and then you'll learn this through experience. So when you purchase a home, the property taxes in Iowa are always assessed in arrears. So they, for example, property taxes were just due at the end, well, I guess, are due at the end of September. But the property tax payment that's being made at the end of September was for property taxes that were assessed in the previous year. So I think even the beginning of 2022. So you've got this long period got this long lapse between when the taxes are assessed and when they're actually paid. That means that when you buy property or sell it, you have to reconcile what you owe on those property taxes if you're selling, right? And what happens is the sellers will get a credit. The buyers will get a credit for the amount of property taxes that have yet to be paid that are gonna have to be paid in the future. So for property taxes to be deductible, you have to both own the property at the time you paid the tax, and you have to pay the tax. So it's entirely possible, and what oftentimes happens, especially when you're a new homeowner, is that for the first year or so, even though you're writing a check or it's part of your monthly payment, those property taxes, even though money's going out, you don't get a deduction for it. Because those taxes were assessed during a time period when you didn't own the home. And you received a credit from the seller for that. They gave you money to pay. They gave you money up front and said, here, this is what you're going to owe in the future. This is to be used to pay that in the future. So there can be some timing issues, not only with trying to figure out when those taxes were paid, but when we're talking about real estate taxes, there's some weird, quirky stuff as well with regard to when those taxes are assessed and when they're actually paid. I know that's complicated, and believe me, that is something that even seasoned taxpayer or tax preparers have to think through as well when they get it. And that's always a question that you ask clients: is did you buy or sell any property this year? Because if they did, then you have to get additional information from them in order to properly account for the property taxes. Let's see. So all of these taxes, personal property taxes, state, real estate taxes, other state taxes, think income taxes, and foreign taxes, there's a limit on the total amount that you can claim as a deduction, and that limit is $10,000. So in total, those expenses, those taxes paid cannot exceed $10,000. Any amount over that is not deductible. So again, there's another limitation that's been placed. That was a change in 2017. That was a big change. There are states where property taxes are outrageously expensive. States in the Northeast in particular, and on the West Coast, you can pay property taxes of $20,000, $30,000 a year on property that's average, right? So it's huge, which meant that people in those states got a big deduction, right? They were able to claim that as a deduction on their tax returns. Well, when this changed, now they were limited to $10,000. So there was a lot of outcry from people in high property tax and high income tax states that, hey, wait a minute, now this is no longer deductible to us. Iowa actually is, like I said, it's kind of a mid-range state for taxes, but there were a lot of people that were affected by this, where their combined property and income taxes were high enough that they were significantly over that $10,000, and now they weren't able to deduct it anymore. So that was a big change, caused a lot of consternation. I think people are kind of used to it now. They still don't like it. So it's $10,000. $5,000 for married filing separately. Now that $10,000 limit is even if you're single. So married couples or single. So that's kind of a little bit of a marriage penalty there. But married filing separately, it's $5,000. What else do I want to say? Personal property taxes, like I said, think car registration fees. Now, the portion of car registration fees that is deductible is also limited. So there are a couple of different ways to value car registration fees. One is based on the weight of the vehicle, one is based on the value of the vehicle. Certain states do it one way or the other. Certain states combine the two. Iowa is one of those states that combines the two. Only the taxes assessed on the value of the vehicle are deductible. So now you've got to do a calculation to figure out, okay, I paid $300 in car registration fees, but only a portion of that $300 is actually due to the value of the car, the rest is due to the weight of the car. So only that portion that is due to the value is going to be deductible. In Iowa, they do have a formula that you can use, like the state revenue department puts out a formula that taxpayers can use to determine what that amount is. And it's based on the year that your car was produced, the year that your car was produced, and the type of the car, and the weight of the car. There's all these different factors that go into it. Accountants, we would generally use $16. Because if you went through all the calculations, it always came out to about $16. So we would use just a flat $16. And we would subtract that amount, that was the amount that was based on the weight of the car, not the value of the car. How we get on time here?
20 minutes.
Okay, I'm not gonna go through that then. Oh, they mentioned that. So the vehicle registration fees. Now, property taxes on real estate, like I said, you have to both own the property and have paid the tax. Sometimes, and they go through this, another issue, so sale of property during the year or purchase of property during the year can create some intricacies, but also jointly owned property. So if you own, and which happens, when it's your spouse, it's pretty easy because you just throw it all on the one tax return. But maybe you own a house jointly with your mother, or with your brother, or somebody, or with a friend, right? Or it's a couple that's not married, but they own property together. Now you've got to divvy up that property tax between the two, and there are a couple of different nuances to that. So joint owners in most states and counties, joint owners of property are jointly and severally liable for property taxes. This means if one person doesn't pay the tax, so you own a house 50-50 with somebody, you have tax of $2,000 a year, and you're responsible for $1,000. You've always paid $1,000. They've always paid $1,000. They don't pay the $1,000. You're responsible for the whole $2,000. As far as the state is concerned, if you are jointly and severally liable, that means that each party is 100% responsible for it. They can go after either party or both parties for the entire amount. Okay? In those states, so in this situation, it's the owner who pays the tax who deducts the tax amount. So whatever you paid is what you deduct. So we've got two brothers, Jacob and Rami. They own a parcel of real estate with ownership interests of 30% to Jacob and 80% to Rami. Jacob pays the entire $2,300 of real estate tax. If they lived in a state where all joint owners are jointly and severally liable for the tax, Jacob would be able to deduct the entire $2,300 because he's responsible for the entire $2,300. If, however, he lives in a state that doesn't have joint and several liability, then he only pays what he's responsible for, as long as he paid it. So even if he paid the $2,300, he could only take 30% of that $2,300 because he wasn't responsible for the other 70%. Okay? As it says here, so if local law mandates that co-owners of property do not have joint and several liability for a tax, then only the proportionate share of the taxes can be deducted. So again, you have to have paid it and you have to be responsible for it. Okay? I gonna go through that, I pretty much explained that. I already talked about this concept of property taxes on property that is sold during the year. They have kind of a different calculation here than how Iowa does it, but it's still kind of the same concept. So I'll go through this I'll go through this example here. March 1st, David sold some land to Moesha. The real estate tax of $3,300 was not due until August. All right, so David, if he still owned the property in August, he would have paid the entire amount of property taxes for the year, the $3,300. But he didn't own it for the whole year, right? So he's not responsible for paying all of it. In August, Moesha paid the entire $3,300, even though it was for all 12 months and she did not own the property for 12 months. So in this case, what happens is that David is going to have to give her the proportion of the taxes that belong to him. So he would pay, and this would happen on the selling, the selling statement. They would transfer from David to Moesha whatever those 3 months worth of property taxes, so that when the time comes, she has been reimbursed for the amount that she's going to have to pay. So even though she didn't pay, she didn't live there the whole year, and she's only going to get to deduct 9 months worth, 10 months worth, because this was March 1st. She's been reimbursed for those other 2 months here. And David would also get a deduction for those 2 months. Okay, he gets to deduct the $533. All right. Real estate taxes. So these are property taxes. Again, we're limited on all of these combined of $10,000. Let's see here. And this is just personal property. So if you have business property, so you own a business and your business owns property, those property taxes would be reported separately on the business return. This is just personal property. Here. Let's see. Okay, oftentimes when you have a mortgage and you pay every month, part of that mortgage is what's called it goes into what's called an escrow account. So your principal and interest amount maybe is $1,000. Here, I'll give you an example here. Let's say you have a monthly mortgage payment of $1,200. Of that $1,200, it includes principal and interest. It includes amounts for property taxes and amounts for insurance, homeowners insurance. This is the amount that you're paying off the home. These amounts are annual amounts that are due that the mortgage company keeps in trust, and then when the payment comes due, they then send the payment out. So they collect it from the mortgagee throughout the year. So we'll say the principal and interest is $800 every month. The property taxes are $300 a month, and the insurance is $100 a month. Okay? That gets us up to $1,200. These property taxes, so you're paying $300 into this account every month, which times 12 months would be what, $3,600? $3,600. So over the course of the year, the mortgage company is collecting $3,600 from you, because they know approximately that's how much is going to be due for property taxes, but it's never exactly that amount. So the property taxes come due, and the mortgage company pays $3,300, because that's what's due. That additional $300 just stays in your escrow account. It'll get applied to next year, how much is collected. Probably they'll reduce this amount that they take every month in order to make up for that. Even though you paid $3,600, you gave them $3,600, the actual payment was $3,300. This is the deductible amount. Not the monthly amounts that are withheld from the mortgage company, but the amount that the mortgage company actually paid is what is deductible to the taxpayer. Questions about that? You guys
So
are starting.
what happens to the escrow account, like, after all that is accumulated, what can you use escrow for, I guess?
Well, the escrow account, what they're doing is, so they're just collecting these two amounts every month, putting it into a separate savings account.
Mm-hmm.
When they're just setting it aside. When the bill comes, they pay it. So like this one, this is $1,200. And let's say the payment was actually $1,000. Well, that means you've got 200 here and 300 here. This balance carries over to the next year.
Okay.
So what they'll probably do is they'll apply that to the property taxes for next year, and then they'll spread out that amount that you have in there. They'll spread it out over the course of the year, and they'll reduce what they collect the next year.
Okay, what if they under, yes,
Then oftentimes what happens is you will have to pay an additional amount, and the next year, you'll have to pay, this amount will go up. Because they would anticipate that, okay, well, now it's not $3,300, it's $4,000, so now we're gonna have to collect more every month in order to make that payment.
wow.
But, so mortgage, even though, so this amount is never gonna change, this 800, but property taxes and insurance, they change every year. They tend to only go up, like everything else. Let's see, and that's what they're talking about here, the fact that with the escrow account, but the key point there is that the amount that you deduct is the amount that's actually paid by the mortgage company. Okay, not the amount that was withdrawn for escrow purposes. 10 minutes. All right, state and local taxes, I already kind of talked a lot about this. So it is usually one of the largest itemized deductions for a lot of taxpayers. 7 states do not have any form of income tax. Those are the states that would then be using the sales tax calculation for that deduction. Let's see, and again, you have to be careful that it's the amounts that were actually paid in taxes, and that could be how much was withheld from your paycheck. That's included. So the withholding would be included. And these are amounts paid to the state. So like say in 2022, paid to the state. Withholding, $10,000 over the course of the year. Maybe last year, when you were doing your 2021 tax return, in 2022, you had underpaid your state income taxes and you owed a couple $100. So, 200, and this was the amount paid with 2021 return. But it was paid in 2022. The actual cash went out in 2022. So that's why it's deductible. It would be included in this year. Maybe estimated payments were made to the state of, I don't know, $1,000. They were made on a quarterly basis, $250 every quarter to the state. So your total payments to the state would be all of this, so $11,200. That would be included as deductible. Now, you get a little problem because you're over $10,000 just with your income taxes alone. So it's pretty easy to get this if you're itemizing, chances are you are gonna be limited in this particular deduction. Because most people who itemize are gonna be in a tax bracket where they're probably paying higher amounts of property taxes and state income taxes, naturally. We talked about the state refunds. So remember, if you paid these amounts, but then you got a refund on some of those, if you got a deduction on the previous year, then it's income in the current year. Just like the medical expense reimbursement, right? You got a benefit from it last year, so now you're getting that back. You've got to pay, that you have to include it as income. So that's why those when we talked about the state refunds. Let's see. This is a good example. I'm not going to go through this, but this also is a good example. I would advise you to kind of read through that for the timing of those state payments. It also includes the added wrinkle of receiving a refund as well. So this is why when you take the standard deduction, you're not getting a benefit from taxes paid, and so therefore you don't have to pay tax on that refund because you never got a benefit in the first place. You never got a tax benefit in the first place. What else do I want to say here? $10,000 limit for all of those. I already talked about the state sales tax deduction. So this is the calculator. Let's see what it looks like. So answer a few questions about yourself. Tax year. Oh, I can't. Do I have a? Oh, anyway. So there's this calculator. The factors: what year are you deducting it for? What was your income? Where do you live? And then it pops out a result for what you can deduct, right? So if you're in a state that doesn't have income tax, you can use that. And of course now I've got to go back here again. So again, you're going to be able to use whatever is most beneficial. So here they've got an example of somebody who lives in Florida. Florida does not have a state income tax. So residents of Florida would use the sales tax calculation instead. Well, here, I'll just let me see, make sure real quick since I'm back here. So enter the tax year, 2022. Marital status. What's this here? How many dependents? None. Did you purchase or start a long-term lease for one of these items? Now, why would they ask you this question? Because the calculation that they're doing is based on the assumption that nothing unusual happened. You didn't buy anything unusual during the year, right? But if you bought a car, you paid a big chunk of sales tax when you purchased that car, right? So you'll get to add that amount to the calculation. We'll say no here. So, adjusted gross income, let's see, it was 100,000. Nothing, we didn't have any of this, we'll just go next. Residence, let's see. Enter the places where you live. Did you live at the same address? Sure. Zip code, oh shoot. So what's a Florida zip code? Oh, 33, here we'll do 33755, there's Clearwater, that was in there. Your total sales tax deduction is $1,068.67. So it spits it out for you. You can do this as well, like if you're in Iowa and you really didn't pay any much sales tax, let's see, Beaverdale. So for Iowa, it would be $1,125.93. If you didn't have any of the state income tax to deduct. Oh shoot. So that's how that thing works.
Okay, I have
Foreign taxes, if you owed money to a foreign country, then those taxes would be deductible. But like I had mentioned before, there's a foreign tax credit. Usually credits are better than deductions. There's a foreign tax credit that usually will help reduce your tax dollar for dollar. This would just be a percentage based on your marginal tax rate. And that would include, so income taxes, property taxes, other types of taxes as well that were paid. You cannot take a credit and a deduction for the same taxes, but you can take the credit and the deduction in the same year, just not for the same taxes. So you can't double up on the taxes. I'm not gonna go through the documentation. You do need documentation for these things, but here we go. So just a summary of the different types of taxes that would be deductible. You can see how that $10,000 would add up really quick. That $10,000 limit. You could arrive at that pretty quickly, right? With all of these taxes. Okay. Any questions on sales tax or income taxes, state and local taxes? It's called the SALT deduction, state and local tax, SALT. Okay, you have a question?